the equal opportunity to achieve success and prosperity through hard work, determination, and initiative. That's what the American dream is, or at least that's what it once was.
Prices rising and interest rates reaching up into the 7% range. Local realtors tell me it's a tough time to buy.
Wages for workers stagnated. The lower 90% only rose by 0.3 percentage points. And that kind of income inequality imperils our democracy.
The American dream is hope. Hope for a brighter future for yourself and the people that you love. Depending on which generation you belong to, you might have an opinion on why younger generations are having a tougher experience in life. However, consider the people in your own life. Do you know people who can only rent an apartment or a house who are struggling to build up a down payment? Do you know someone who still lives at home with their parents? Are younger generations at fault directly, or is this in fact the system that's in place that's working against them? It's time we solve this mystery and see what's broken in the system, and see if there's a solution that can help individuals and possibly entire generations. Workers across the United States are living paycheck to paycheck because of the reality of wage stagnation. Inflation has only worsened the problem in the past couple of years. The cost of living continues to increase, wages continue to stagnate, and the things that have to give way are savings, retirement, and investing, a bleak future that might be realized for most Americans decades from now. Wage stagnation in the United States is a complex issue that's affected Americans for over 4 decades. Wage stagnation directly affects individuals' purchasing power, which is the amount of goods and services that can be purchased with a unit of currency. Since 1979, wages have not kept pace with increases in productivity. As a result, real wages have not grown. While nominal earnings have increased from $2.50 in 1964 to around $23 in 2019, real wages have stayed almost exactly the same. This means that your buying power in 1964 at $2.50 is almost exactly the same as your buying power at $23 in 2019. So let's say that in 1964 an apple costs you 5 cents or 2% of your wage. Due to wage stagnation, your nominal wage will have increased, but the apple would still cost you 2% of your wage. So in 2019, the apple would cost you about 50 cents. But why have wages stagnated? Well, the answer is complicated, but there are a few main factors affecting wages in America. The labor market is very different today compared to just a few decades ago. The world has made exponential technological advancements since the 1970s. As a result, this rapid development of technology and automation has had a significant impact on the job market. While technology has increased productivity and efficiency, it has also led to the replacement of certain jobs, particularly in the manufacturing and low-skilled sectors. However, technology isn't the only reason why wages have suffered over the years. The rise of globalization has also opened up new markets and increased competition. Many companies have outsourced jobs to countries with lower labor costs, which has only intensified competition for jobs domestically. This has resulted in a decline in wages for certain industries and occupations as companies seek to reduce costs. But stagnating wages can't only be attributed to technological advancements and globalization. Economic policies have also affected wages. The minimum wage, for example, has not kept up with inflation, leading to a decline in its real value over time. The minimum wage would be over $18 per hour if it kept pace with productivity. Instead, the real minimum wage is as low as $7.25 currently. An average real hourly wage of a typical worker is about $11. On top of that, income inequality has been on the rise in the United States, with a significant portion of economic gains going to the top earners. This concentration of wealth and income at the top has limited the resources available for wage growth for the majority of workers. Since 1979, middle wage workers have seen a real wage increase of 6%, and low wage workers losing 5%. The higher up you go in workplace hierarchies, the wider the wage gaps become. CEOs now make on average 400 times more money than a typical worker. Overall, income inequality continues to grow, wages continue to stagnate, and workers' purchasing power continues to stagnate, if not decrease. These systematic issues have plagued the labor market and the workers' ability to live a financially healthy life. The 2008 housing crisis stands as an indelible scar on the United States' economic landscape. It was a tumultuous time when the foundations of the real estate market crumbled under the weight of mortgage-backed securities and a regulatory environment riddled with loopholes. The stage was set for a perfect storm that would unleash unparalleled damage on the nation. Median house prices, once soaring to dizzying heights, plunged by a staggering 29% from July 2006 to January 2009, sending shockwaves throughout the economy and triggering what would later be known as the Great Recession. In the aftermath of the global financial crisis, governments and central banks around the world embarked on a mission to salvage their economies and restore confidence in the housing markets. Their collective efforts aimed to address the underlying issues that caused the crisis, while paving the way for sustainable economic growth. It was a monumental task that required bold and unprecedented measures. Central banks took decisive action by lowering interest rates to historic lows. This maneuver aimed to stimulate borrowing and investment, as well as make it more affordable for individuals and businesses to access lines of credit. Simultaneously, governments implemented robust stimulus packages, injecting funds into the economy to jumpstart growth and counter the adverse effects of the crisis. Financial institutions, recognizing the need for tighter lending standards, implemented measures to ensure greater prudence and stability in the lending market. The combined impact of these actions gradually restored confidence in the economy and set the stage for the recovery of the housing market. Central banks' commitment to maintaining low interest rates for an extended period of time after the financial crisis was a key driver in the resurgence of the housing market. Borrowing money became exceedingly cheap, granting aspiring homeowners access to historically low mortgage rates. This favorable interest rate environment shattered barriers and opened doors for a new wave of buyers, fueling increased demand for housing. As demand surged, so did prices. As a result, home prices appreciated from January 2009 to present day by about 208%. The demand for housing outpaced supply in many regions, creating a scarcity that further propelled price increases. Factors such as population growth, low interest rates, urbanization, and limited land availability converged to create an imbalanced equation. The number of potential buyers far outweighed the available housing inventory, triggering intense competition and driving prices to new heights. It became increasingly challenging for young and first-time homebuyers to enter the market and secure a home of their own. The stage was set for a new chapter in the housing market's narrative in 2019, when the world was hit by an unexpected and unprecedented crisis: COVID-19. Governments responded swiftly by issuing stimulus checks to individuals, injecting vital funds into the economy, and expanding the money supply. Innovative programs like the Paycheck Protection Program emerged, providing crucial support to struggling sectors and businesses. Meanwhile, the pandemic necessitated a seismic shift in work dynamics. With the fear of disease transmission, workers no longer needed to physically commute to their jobs. This newfound flexibility fueled the desire for change, with workers seeking homes that offered greater comfort, space, and access to nature. At the same time, the demand for housing has generally outpaced the supply in many regions, leading to price increases. The convergence of these extraordinary factors ignited a housing market boom of unparalleled proportions. Workers found themselves with increased cash flow from stimulus measures, complemented by historically low interest rates and the newfound freedom to work from anywhere you want. It was a transformative period unlike anything witnessed before. Yet amidst the surge in home prices, fueled by unforeseen economic events, the dream of home ownership remained elusive for many. The rapid appreciation in home prices only widened the gap for workers who aspired to purchase a home. Despite periodic fluctuations, home prices have barely budged from their all-time high levels. The prospects of a significant price correction seem uncertain, leaving many young Americans grappling with the enduring challenge of accessing affordable housing. The combination of wage stagnation and rising home prices presents significant challenges for prospective homebuyers. The affordability crisis created by soaring housing costs and stagnant wages calls for a comprehensive and coordinated response. To alleviate these difficulties, it's crucial to address wage stagnation by implementing policies that promote fair wages, worker protections, and skill development. By increasing income levels and improving job opportunities, individuals will have a better chance of saving for a down payment and qualifying for favorable mortgage terms. Simultaneously, efforts to make housing more affordable should focus on increasing the supply of homes and supporting affordable housing initiatives. By expanding housing options and providing financial incentives, individuals across income levels can find suitable and affordable housing options. By tackling wage stagnation, addressing the affordability crisis, and fostering a supportive economic environment, we can create a future where owning a home is attainable for more individuals. It's through collective efforts and a commitment to sustainable solutions that we can overcome the challenges posed by wage stagnation and rising home prices. By ensuring affordable home ownership opportunities, we can build a more equitable and prosperous society for all.